Over the last 2 years, the value of everything from G-Class Mercedes to Rolex Submariners, luxury handbags, and trading cards has taken a huge hit. Basically, if you saw a luxury product in a sketchy ad from some guy trying to sell you a dropshipping course, it's probably halved in value. If you are ever feeling bad about your own personal financial choices, go and watch finance brokers try to unwind someone who has $150,000 in negative equity on an electric Hummer that they purchased with an 8-year loan to rent out on Turo. It should make you feel much better. But I am sorry to tell you that these things might be starting to turn around for these douchebags. We are re-entering a market where Bitcoin is breaking all-time records, stocks are only going up, and Dogecoin is worth more than Nintendo, Delta Airlines, or the Ford Motor Company. In a market where prices only go up, you better brace yourself, because people are going to say that just about anything is an investment to convince their customers, to convince their partners, or just to convince themselves. But that doesn't matter, as long as they can't convince you.
That is how I could justify spending $11,000 on a first edition pack of Pokemon cards from Logan Paul.
That watches are actually not just fashion, not just a statement about who you are.
I have been collecting these bags for a minute. They're also a great investment.
I'm sorry. You owe about $190 left?
Yeah.
All right. Hummer EV. Did you see my other Hummer video with the guy that was like $100,000 upside down?
Yeah, that was, yeah.
Alternative investments do have a lot of attractive qualities for sophisticated investors that know how to effectively use them. Assets like commercial real estate, patents, private equity, distressed debt, commodities, and even some collectibles have been purchased by wealthy people as part of their broader investment strategy because they do actually have a few advantages. The value of these assets are often uncorrelated to the return of the stock market, which means that if you are a wealthy individual that loses their job during a market crash, you won't have to sell your investment at record low prices to stay afloat because some of your alternative investments should still be doing fine. If you just had investment in equities and lost your high-paying job in a market crash, you might be forced to sell your shares at the bottom of the market, which, as the finance bros say, is not awesome. Some alternative investments also let their investors have more control over their value. If you own a boring, old, well-diversified stock portfolio, there isn't much you can do to make the whole stock market more valuable. If you own a piece of commercial real estate or even something like artwork, you can market it, or do it up, which might help improve its sale price. Alternative investments also generally have less competitive markets. If you are trying to find an edge in the market for stocks or bonds, you are going up against teams of quantitative analysts from Jane Street and Citadel Securities who did a 4-year math program at MIT just to eke out 5 basis points of alpha. You might actually know something about a niche alternative investment that does genuinely give you an edge without it bordering on insider trading because the Securities and Exchange Commission really doesn't care about what happens in these markets. Now, if you are an industry insider, that could be a really good thing. But more likely for you, it's a really bad thing. So before you go and rethink that Masterworks investment, you should also know about the long list of drawbacks with alternative investments. They are normally highly illiquid because the market for them is niche, which means finding a competitive buyer can sometimes take years. They are also much more expensive to buy and sell. You can buy stocks on any number of commission-free brokerages, and while they do have some hidden fees, they are barely a rounding error. If you want to sell a piece of artwork, piece of jewelry, or some other collectible, you are probably going to need to go through an auction house or third-party dealer. Sotheby's, for example, is the most well-known auction house in the world, and they charge a 20% commission on any sale under $10 million, which is actually paid by the buyer. Any investment where you are automatically 20% down the moment you make your purchase is going to be risky, at best. But let's be honest, most of you watching aren't seriously considering a multi-million-dollar artwork to round out your investment strategy. And if you are seriously considering a syndicated artwork investment system, then I have really failed to teach you how money works. The alternative investments that have really been generating all the attention are manufactured luxury goods that can't keep up with demand, or intentionally limit production to create a sense of exclusivity. High-end luxury watches from brands like Patek Philippe and Rolex, limited-run cars, as well as certain designer shoes and handbags all have long wait lists from authorized dealers that can stretch for years before you're even allowed to drop 5 figures on a fashion accessory. This has created a huge gray market for these items where people can wait to buy a bag or a watch from these stores and then sell them for a premium to a buyer who just wants their new toy right now. Something that you can buy one day and then instantly sell the next day for a huge premium sounds like the most risk-free investment there is, and it would be if it actually worked like that. People have seen the opportunity to make some easy money and have ran with it so hard that there are even sites that collate sales data to make trackable indexes, which, as you can see, have not been telling a good story about the actual performance of these investments. It might be unsurprising to you, but the hype around these markets is also highly correlated with the hype around other alternative investments like cryptocurrencies. And with the current massive rally in dog-themed financial instruments and other such nonsense, we gotta talk about it before anybody else does something stupid. So it's time to learn how money works to find out just how risky these alternative investments can be. This week's video is sponsored by Ridge. I've always had a habit of carrying way too much in my wallet, but switching to Ridge has really simplified things, and they've perfected the art of a minimalist functional design. Their flagship Ridge wallet is slim, secure, and fully customizable. It holds up to 12 cards, has RFID blocking technology for extra security, and comes with options like a cash strap or money clip, all while fitting comfortably in your pocket. Plus, with over 50 colors and styles, there's something for everyone. It's also made from premium materials like titanium, aluminum, and carbon fiber for lasting durability. Personally, I love how Ridge wallets make carrying essentials simple without the bulk. It's been a game changer for staying organized and secure on the go. And with Ridge's Black Friday and Cyber Monday sale, you can get up to 47% off. Whether you're gifting someone or treating yourself, this is a great time to upgrade your everyday carry. Check out the sale and find a gift that's built to last at ridge.com/money. There is, of course, another reason why people are attracted to highly speculative alternative investments, and that's simply their potential to be a lottery ticket out of poverty. A well-diversified portfolio of stocks, bonds, and real estate is an incredibly powerful tool to build wealth. But if you don't have any wealth to begin with, even Warren Buffett-level returns won't make you wealthy within your lifetime unless you can make consistent contributions towards those investments. Cryptocurrencies, meme stocks, trading cards, and even straight-up gambling is giving hope to a lot of people, even if for most of them it will only make their problems worse. But for the lucky few who did time their purchases correctly, they have turned incidental amounts of money into very substantial positions. The people that have sold out of these positions have a higher propensity to consume, especially on luxury goods to show off their new fortunes, which was in part why the aftermarket for luxury goods saw such a boom from 2020 to 2022. The trend was so strong that these items were seen as investments themselves. The brands themselves, although they would never publicly admit it, heavily played into this idea of scarcity by limiting their production of popular products and raising prices above the rate of inflation year after year to make it seem like it was a privilege to pay the price of a family SUV for a watch. At the end of the day, these are companies with a profit motive, and the only reason they would limit production is because it would increase the premium they could charge. Paying $50,000 for a watch seems stupid, but if someone that just made a fortune on a monkey JPEG is willing to buy it off you for $100,000, then it's just responsible investing. But what is particularly interesting is why this isn't happening again this time. The price of highly risky investments is up, but the price of all the junk that people normally buy when their Dogecoin moons has stayed down. So, what gives? The logical answer is that sports betting and meme coin speculators have suddenly become very fiscally responsible. And instead of blowing their profits on babbling goods to show off their newfound wealth, they are prudently investing it into a structured portfolio to provide them with a stable return. Yeah, okay, so there are actually 3 things that have happened here. These dumb expensive trinkets that people insisted were great investments are actually an indication of a much bigger shift in the economy and habits of retail investors. The first big change is that these markets, which used to be made up of small-time, unsophisticated investors, have become just as consolidated, if not more consolidated than traditional equities markets, with the largest, wealthiest investors controlling a huge share of the total supply of things like cryptocurrencies. Bitcoin going from 20k to 90k in a year will make people a lot of money, but it's going mainly to the type of people that already had a lot of money to put into a risky investment. It's a huge return, but to someone who only had $1,000 to invest, it's not going to make them life-changing amounts of money like it would have if they invested early in the 2010s. If the Winklevoss twins make an extra $1 billion on the appreciation of Bitcoin, they are not going to wear 100,000 Patek Philippe's, which means even though the net wealth creation might be the same, the resulting propensity to consume is much lower when the rewards are going to people who could have already purchased any luxury good they ever wanted. For many of the small investors who want a chance to make life-changing amounts of money from their limited capital, the boat has already sailed on Bitcoin, which is why people keep falling for rug pull after rug pull on the promise that this time will be different, because they simply need the chance. The reason that people are making these gambles is also different. A Wall Street Journal survey of investors with low FICO scores found that their primary reason for investing was not to build wealth, but to pay off debt. Credit card debt is now approaching all-time highs, and interest rates on all kinds of borrowing is up. So even when people are lucky enough to turn a profit on these extremely risky investments, they are just going back to square one, not actually getting ahead. 4 years ago, dumb investments were turning people's stimulus checks into enough money for a down payment on a Lamborghini Urus. Today, they are lucky if it pays off their heavily underwater car loan. People are no longer being greedy. They are just being desperate. Now, you have probably experienced this cultural shift from the pandemic-era exuberance to the more cautious financial environment today, even though most macroeconomic indicators are up and to the right. But these investments are also getting hurt by a market where none of you are watching from, which hasn't even been able to make its broad economic indicators look good. China has become the largest market in the world for luxury goods because the country has produced a lot of wealthy people very quickly, and those people are eager to show off their newfound fortunes with luxury goods. Unfortunately, real estate, the primary wealth generator in China and the single largest asset market in the entire world, has been floundering since Evergrande and other major property developers started failing and flooding the market with more apartments at fire sale prices. This wealth destruction, along with a strong push by the government to crack down on extravagant displays of wealth, has meant demand for luxury goods in the country has fallen, at the same time as luxury good companies have expended to keep up with demand that has disappeared. It should go without saying, but even really smart people can do stupid things with their money if they want something to be true. A lot of people want to convince themselves that their new luxury purchase is not only a nice toy, but a prudent investment, when it simply isn't. Even if there is a premium between retail price and what it could be sold for in the gray market, you normally have to spend a lot of money at authorized dealers before you're allowed to get to the front of the waitlist. After that, the risk-adjusted returns are probably very bad, if not non-existent. If you want to invest your money, invest your money. If you want to buy something nice to treat yourself by buying something nice, treat yourself. Don't compromise and do both poorly. Now, the bonus fourth reason is the cultural shift away from conspicuous displays of wealth. I'm going to be writing an article on my completely free email newsletter about why role-playing as a poor person has suddenly become the new trend amongst wealthy people, especially in big cities. And if all this has convinced you to stick with traditional investments, then go and watch my other video on why you are not actually an investor at all to keep on learning how money works.